Let's get into some other questions here. This is a good comment. Let the bulls and the bears fight it out, and then move in to scalp their dead bodies. And that's an interesting that's an interesting perspective. What's meant there is when things are nuts, walk away until things are not nuts. If it's chaos, just stand on the sidelines and wait for something appropriate. Wait for the market to start moving, and once the market has done, throwing its temper tantrum and going crazy over a news release or off market hours or whatever else, then you can act. When you see something like that, skip it. Just move on to something else. How many hours do I spend in front of the computer? I'm busy doing a lot of different things. And what I'll do is I will have, I won't sit there and stare at my charts for 4 hours on the 15-minute time frame. That's just going to cause me, major headaches. And it's not something I care to do anyway. I don't like sitting there and staring at things. So I'm gonna have my system open. I'll check it. I'll have done my analysis and I'll check it periodically, and I'll keep an eye on it. And when I check it, I know I'm looking for certain things. So it takes me 5 minutes to check 3 charts and say, okay, yeah, this is good, this is good, this is good. All right, I'm good to go. So I'll get into a trade, place my stop and my target, and then I'll come back a little later to see what's going on and manage the trade. And so I'm at my computer most of the day, but I'm not constantly staring at my charts. And it's funny because the more often you stare at your charts, the less good you're going to do. It's almost counterproductive. If you understand what you're doing and you have a good perspective, it doesn't take long to check for what you want to see. And if you know what you want to see and you're not seeing it, then you just walk away. And so that kind of keeps the headaches down to a minimum. Do I find that news affects intraday trading? Absolutely. If you get a high-impact news release, NFP is kind of a favorite one to pick on, non-farm payroll. That can really do some funny things. I've seen the market move 100, 200 pips because of a stupid news release. And NFP is notorious for screwing with stops and targets and all this stuff, because the spreads get real wide, and all of a sudden, you had a 2-pip spread and a 20-pip stop. Well, now the spread's increased to like 8 pips, and all of a sudden you've got a 12-pip stop, and the market moves 12 pips in the blink of an eye when a news release comes out, and you're out of the trade. And it's just something that you really want to be careful of. You know what? This is yes, Sharon. If you see a any kind of high impact news release coming out for that day on a pair that you're thinking about trading, find something else. And if you can't find something else, take the day off. That's the best thing that you can do. Sometimes the best position that we can take is no position at all, and that's something you got to watch out for. There have been red flag announcements every day lately. Does that mean not to trade? You know what? If there's constantly the USD has had a lot of red flag announcements, and so trading during those times is really a bad idea. You can trade up to about 45 minutes, maybe 30 minutes prior to that release. And then once the market's settled down, usually that takes about 30 minutes to an hour afterwards, maybe even a little longer. So maybe a half hour before the news release and a half hour to an hour after the news release. You want to skip those. And if there's high impact news releases throughout the day, like if one gets done 2 hours later, there's another one, then find another pair to trade. That's find something else to think about. And if there's just too much news coming out for that one day, then yeah, definitely take the day off. So we will move on to our next one here. I think this next one, not paying attention to what's going on, really plays a part in what we've talked about already. It just, you open up your charts and you think you're late, so you get in and you lose a trade, or you open up your charts and you don't do your analysis properly. You don't take the time. You spend 5-10 minutes per time frame just looking at it and get a feel for what's going on, and slow down and pay attention. And that's really going to save you if you can learn to pay closer attention and just relax and just look at the charts and say, okay, you know what, this is what I see. And as you work down those time frames, you're going to be able to act more appropriately, and you're going to be able to act accordingly to what's actually going on in the market, rather than based on an emotion like, oh, it's going up, so I got to buy, or oh, it's going down, so I got to sell. And the lack of patience too. We as traders want to make money, okay? And it's hard to sit there and watch the market move, knowing that had you been there 15-20 minutes earlier, you'd have been able to catch the big move that you're watching right now. But if that's the case, a lot of it, one of my favorite questions is how do you catch a falling knife? And the answer is simple. You let it hit the floor. You want to let the market, do its thing. If the market's taking off, if the market is falling like a knife or shooting up like a rocket, let the thing hit a ceiling and then come back, pull back, and then get in on a pullback. Get in when the market slows down, comes back, and then get some more steam. And that's what you're gonna find is really gonna help you guys. So this is one that we kind of mentioned a little earlier. Jumping the gun and not pulling the trigger. We either get in too early, or we are assuming that we know what the market's going to do. We'll see a setup. The market, is oversold. Say the RSI is at 80 or something like that, and we know it's going to crash, and the market's just shooting up, and it's way oversold, and we know that the market's going to come down, so we just sell. Okay, and the market goes up another 100 points. So, one of the things that we need to avoid is getting in too early and assuming we know what's going to happen. Or, on the flip side, we see the market going up, we know it's oversold, and then it turns, we've drawn a trend line or whatever else, and, we get a solid entry. But we're scared because it's gone up so much, and we think, oh no, what if it keeps going higher? What if I'm getting in at the wrong point? And then we wait, and 4 bars later, the market's crashed 100 pips, and there's really only 20 pips or so left on the table. We've missed it. We come late to the party and try to ride the tail end of a move that's already over. And so we don't want to do that either. And timing is crucial. Knowing when to get in, that's an awesome, important point. But timing on your way out is also crucial. And set your targets. Know your entry, get in. A lot of times, getting into the market isn't necessarily the problem. It's getting out. And we want to set those targets. We want to move our stops. We want to manage the trade. It all comes down to trade management. Just going to get to a comment here real quick. Yeah, this is a good comment, Mike. He's saying, it seems to me that the greatest threat is lack of patience. There seems to be a lot of times when I got into the market, or when I got to be in the market all the time. It seems to be some angst when something's not active. That's absolutely right. If you are trading an off market hour, like the New York and London session, the the London session is going to close at noon. Okay, and all the guys in New York City, all the bankers on New York time, are going to be taking their breaks. And they're going to be going out to lunch and thinking about wrapping up for the day, and they're going to go out and have a couple of beers with their buddies, and talk about all the money they made, or, during the New York session. And then they're going to come back, and, they might have one or two still open. They're going to close those out, and then they're going to go home. Okay, they're just it's going to die off after that. And so if you're looking at the market during those off hours, or even in the hours leading up to between 3, 4 in the afternoon up till about 7 o'clock at night, if you're trading during those off hours, there's not much that's really going to happen. You might get some movement. There might be some news releases that come out during that time that'll move the market, but really, like, if you're trading those off hours, you're going to have a less chance. And so stick to, pick the times that you can trade, pick those market hours, pick those market sessions that are going to be active that you can trade, and just trade those. Okay, stay on top of the markets that are that are active and moving nicely. Yeah, this is another good comment. I think it shouldn't matter how much the market moves. We should be happy with our target. Absolutely. Set daily goals for yourself. And once those goals are met, walk away and be happy that you were a successful trader today. That you made money, that you did something that not a lot of people can do. Okay? Not a lot of people can do this. And if you can set goals for yourself and meet those goals, then you did what a lot of people can't do. Okay, and even if you have a string of losses, even if you get up and you have 3 losses in a row, then you know what, and you quit, then that's something to be happy about too, because not a lot of traders will do that either. They'll keep having losses. They'll take 3 losses, and then they'll take another one, and another one, and another one, and they'll keep doing it all day long. And they'll drive themselves nuts, and their account's going to be down 60% in one day. Okay? And that's... a lot of people will do that. A lot of people will go to one extreme or the other, and if you can keep yourself from going to one extreme or the other, and you can set those goals, and you say, okay, if I have 3 losses, I'm out. If I have 3 winners, I'm out. Okay? And set those goals, and whichever one you meet first, walk away. And be happy that you either get to trade another day, or that you've made money and you can continue, you've made your account grow. Okay, that's the name of the game, is staying in the game, staying in the market long enough, or it's keeping your balance in such a way that your losses are at a minimum, that you can stay in the game for the long haul. You want to do this to a point where you can retire off of this, or you can replace your job, or go on a vacation, or there's things you want out of this. And that's what we got to do. We got to stay in the we got to keep ourselves on the right track, and take what we can, and take what the market gives us, and be happy about it and walk away. Now the other thing too is we've touched on this a little bit already. Small losses turn big. We'll either we'll set a stop and then we'll move it, or we will, place a trade and then not set a stop and then just walk away for 3 days. Thinking, well, it's got to come back sometime, and just letting the thing run and run and run and run. Now, the other thing too is that when we have a series of winners, it's going to be, we're going to get overconfident, and then we'll start assuming that we know what the market's going to do, or I can fudge on that rule here, or I'll wing this one. It's no big deal, I'll win it, and that's going to be the time where you have 10 winners in a row, and then all of a sudden you have 3 losses because you were you're a little overconfident. And that's going to be our detriment too. If we get cocky, it's not going to work out in our favor. Think about somebody that you know, okay, that got real cocky with something, whether it was a talent or whatever else, and look how far that cockiness got them. Okay, cocky people don't typically make it too far, and they might have they might get somewhere, or they might seem like they're getting somewhere, but that cockiness, that arrogance is going to turn around and bite them. And when it does, it's going to be nasty. And it's not going to feel real good. And we all know people like that. We've all done that before. We've all done that ourselves. We've all been, a little too arrogant. We've all been a little too assuming. And it's come back to bite us. So now we are going to take a look at extended bars. And what these are is basically a look at being late to the party. Okay. So our first slide here, we've got a chart of, let's see here. We've got the pound yen on a 15-minute chart, and this is a really good example of what I was talking about earlier. We get up, and all of a sudden we see that the market is falling off big time. Okay, it just decided to jump off a cliff, and we get to the market where that big red bar is, where that blue circle is. Okay, and right at the top of that blue circle is about where we get in, thinking that the market's going to take off. Okay, so we get in there, and there's really no decent place to put a stop, so we just kind of trade without one. Okay, and we're in it, and the bar closes, we're in a little bit of profit, we're feeling good, and then all of a sudden the next one just dives off a cliff too. Okay, and we think we're making millions. Okay, and all of a sudden, it pulls right back up to where it started. The next couple of bars go a little sideways, and then it shoots back up. Now we're freaking out. Okay, on the next couple of bars, it starts moving down again. We're like, oh, okay, good. And then the market does something, funny. It turns around and goes right back up to the top. And essentially what we did was we sold at the bottom of a market, because we were late to the party and we didn't want to miss anything. When if we would have waited, we would have had a better entry going back up to the upside. And this could very well have been a news release. Okay, news releases, basically when they come out and they move the market like this, what they'll do is the news release will come out and everybody will freak out because they thought that the initial news release for the pound was bad news. So everybody bailed. Okay, and it took a nosedive. And then they realized, wait a minute, this wasn't bad news for the pound, this was actually good news. And so they just jump back in the other side, and the market flies up to the upside, and there's no balance. Okay, and if you think about it, right up until the time of that big spike there, that big fat candle and that spike, okay, there was 3 bars that went sideways. Then we had the opening of the next bar. It spiked majorly, and then it just plummeted. Okay, those are the times leading up to the news release that we don't want to trade. And then afterwards, we've got the big spike there at the bottom. 2 bars that go a little sideways, and then it shoots back up, and then it falls off again, and it goes sideways until it finally, smooths out and then goes up, goes on up. Okay, that's what we gotta wait for. It's that section right there where all this action is taking place that we want to stand aside and wait for something smooth. We want to wait for something better, and we want to wait for something pretty. The big spikes there, all those dojis, and then the long wick candle, the spinning top there, and then the big red candle, and then the hammer at the bottom. That stuff is scary to trade. It's hard to make money during those times. Here we've got another one. We've got another candle coming up, and a lot of times you'll find these candles on news releases where you'll have this big, huge candle, and then all of a sudden it'll go sideways. And that's something that you want to watch out for. Okay, after a huge move like this, a lot of times it can go sideways and then pull back completely. Okay, and essentially what this was, the market was going sideways for a bit, and then a news release came out. It was all over in here. It went sideways here, jumped up, came down, and then bam, here's that news release. Everybody's getting scared. Everybody's trying to figure out what's going to happen, and it jumps up, and then it continues on down. Okay, and once the market smooths out, right in here, right after all this sideways action right in here, it was a great entry, and it moved down. It was very nice. It was very nice to look at, and it was very smooth. And that's what we want to look for. We want to look for smooth markets. And a lot of times, like I was saying, when you get a big candle like this, it can often signal like kind of the end of a move where it jumps up and then it stalls and then it falls back away. And when there's too much movement, when we sit down and trade, we need to be taking a look at, is this too much too fast? And if it is, if we can answer yes to this, like if it's just one big fat candle, okay, a lot of times that will be the move. It'll take up the move, and you'll want to, back off of that a little bit and wait for a better entry.